Welcome to the Arlington Heights Memorial Library virtual program, First Time Homebuyers Workshop. My name is Barb, and my co-host tonight is my colleague, Jennifer. Our presenters tonight are Sue Duchek and Megan Specht from Picket Realty, Russ Walle from First Centennial Mortgage, and Lucas Weigle from True Home Inspections. Thank you again, everybody, for coming. And now I'd like to introduce Russ Walle, who will talk to us tonight about mortgages and financing.
Thanks, Barb. Appreciate it. My name is Russ Walle. I've been in the mortgage industry for about 27 years now. And 21 of it, I was at a major, national lender, and the last 6 or so, I've been at a smaller correspondent mortgage lender, and that means, we're not a bank where you can deposit money. We are just basically doing mortgages, period. So, we specialize in that way. We underwrite everything ourselves. We fund the loans ourselves. The only difference is sometimes we don't service the loan where you won't make the payment to us, but that's kind of where I'm at now, and been doing this a long time. And I got put first on the list here because this is really probably one of the more important things you want to do when you start this process. You'll want to really figure out what you can get done on a mortgage. So that's basically why I'm going first, to try to set the table for that. I would recommend that you probably get associated with somebody that you were recommended to. It's as opposed to just walking into your local bank where you do your checking and savings. You don't really know who you're going to get hooked up with there and what their experience level is. So if you can get a recommendation, I would highly recommend that option. So bottom line, what I thought we'd do tonight is kind of look at some myths and kind of go over some mortgage myths, and then that'll lead us through a bunch of topics, and hopefully give you some good info on some things to look for when you start working on your mortgage. So myth number one I'd like to talk about would be getting pre-qualified is the same as being pre-approved. So it's different terminology, and the main difference is the level of review that happens between a pre-qualification and a pre-approval. So a pre-qualification basically can be done on the phone in a few minutes. It's not a bad step. It's a good first step if you're very early in the process. Like, I'll talk to somebody and I'm able to very quickly at least give somebody a good feel for what they could qualify for. That's a good place to start. But before you really go out and start, looking at houses, because inevitably if you start looking at them, you're going to want to make an offer on something, but you really need to be pre-approved. This is a very important point. I would definitely have you get pre-approved. And the difference is, when you're pre-approved, it's basically filling out a complete loan application. So you're getting your credit pulled. You're providing financial docs in a lot of cases. You don't always have to. I've been doing this a long time, so some folks I know are going to be good, and they don't have to provide too much, up front. But you have that letter that says you're fully pre-approved by a lender, and that's the only way you're going to be taken seriously when you're trying to make an offer. If you don't have that letter, especially in this market where so many people are trying to buy the same properties, you definitely need to have that set up. So there's no cost to get pre-approved at most locations or most lenders. We don't charge, of course, and it doesn't take that long. I can talk to somebody in the morning and have them pre-approved by midday. In some cases, you can do it online. We've got a pretty good online system, and most banks do now. But that is definitely, to become a serious buyer in the eyes of anybody that's selling their property, you want to get your pre-approval set up. So that's the difference between being pre-qualified and pre-approved. You want to be pre-approved eventually. So myth number two that I wanted to talk about was if you need perfect credit to get a mortgage. And of course, you do not need perfect credit. Now, a lender's going to look at they're going to pull a credit report that has all three bureaus on it: Experian, Equifax, and TransUnion. And the way a lender looks at this is they basically use the mid score, or the middle score of the three. And that's kind of what they base your loan off of as to what it's going to cost you in general. If I can put it in those terms, basically you need a credit score of around 600 or above to get any kind of a loan these days. And if you can get to 740 or higher, that's going to get you into the best loan category. So you're going to get the best rates at that point. And because we're talking, first time home buyer here, I'm assuming that a lot of folks are not going to have 20% down. So, when you don't have 20% down, there's also an extra monthly payment you have to make for mortgage insurance. And that is greatly impacted by your credit score as well. So, credit scores technically go to a high of 850 is like the max. I mean, the best I ever see really of a mid score out of the three is probably in the high 800s. I'm sorry, in the low 800s, maybe 810, 812. But again, if you're 741 or higher, you're great. You're going to get the same deal as if somebody has 800 for the most part. So, that's basically, where you want to be. I mean, if you're below 600 or close to it, we have capability to maybe help you out with some things you can do to kind of improve that score. Even in the immediate, I mean, a lot of the bigger national banks, if you have a bad score, you're kind of out of luck. I mean, they can't fiddle with your credit or try to help you get it improved, in an immediate term. They can tell you some things to do and, tell you we'll try again in 6 months or a year. But so that's something to think about as well. I mean, we would review a credit report and tell you if we could help improve things for you. And so that's one benefit of a smaller a mortgage specialty house. So, so one other thing, in regards to credit, I mean, you hear a lot, you hear people ask if, getting your credit pulled a lot is going to affect your scores. It definitely does affect your score to some extent. I mean, you could probably have a credit pull once a month, and it really would affect it so little it shouldn't impact your ability to get a loan. So I wouldn't worry too much about that. But if you're going to shop around for a mortgage, whoever you do your official pre-approval with, you should get the information from them as to what the score is, so you can just share that with other lenders and they can kind of, base their quotes to you off of that. So you really don't need your credit pulled 6 times when you're trying to work through who you're going to work with on a mortgage. So just wanted to give you that info on that. So myth number 3 that I wanted to talk about is that you need to put 20% down to get a mortgage. And of course, that's not true also. There's 3 main types of mortgages that people go through these days. And it kind of has to do with, each one has got their own little niche as far as why you would use them. And I don't have time to kind of go through all of it at this point, but as to why you'd go with one over the other. But, there's conventional loans, FHA loans, VA loans. That's probably the 3 that a first-time home buyer is going to look at. There's also jumbo loans, but again, that probably doesn't come into play. That's for large loans. But on a VA loan, if you were in one of the armed forces, you can take advantage of the great 0% down program they have. FHA has a 3.5% minimum. And conventional, you can do 3% in some situations, depending on whether you're first-time home buyer, whether you're under certain income limits. But in general, 5% is kind of more in line with what you might be looking at for a conventional loan. And like I said, each one has a different purpose, depending on somebody's overall financial picture. Conventional loan is more, for somebody that's in pretty good shape with their credit, has their down payment in place. FHA is better usually for somebody that doesn't have the best credit, and maybe needs all their money from a gift, or some other extenuating circumstances. And VA is similar to FHA, but again, you have to be a veteran to use that. But all good choices. I mean, down payments can come from a lot of different places, savings, stock accounts. You can take withdrawals from your retirement accounts, or take even loans against 401ks where you don't have to actually take the money out permanently. You can pay that back over time. Gifts are great for first-time home buyers. If you have family members that have some money that are willing to shell out for you to help you out a little bit, that would work. So those are the best, obviously the main places that people get money from. A gift normally has to be from a relative or family member. Sometimes you can make the case of a long-term, long-time family friend and get away with that. But in general, they want to see it's from a family member in general. So, but keep in mind the down payment isn't the only component. You've got your down payment figure you're going to also need for closing costs. And what I usually tell folks is that, you're going to see a higher number on all the documentation, but in general, especially on a first-time home buyer situation, figure you're going to need whatever down payment option you pick or can pull off. And then you're going to also need, probably another $300 to $3,500 in closing cost monies available. And so that would be your total money out of pocket to get your deal closed, in general. So that is pretty much answers the myth about the 20% down. But one other thing, that just a brief aside on that, if you can get your money kind of situated ahead of time, that works better than having money moving all over the place at time of application. It gets a little trickier to verify where all that's coming from, especially large deposits that you may have gotten from friends or somebody you loan money to and they brought it back to you. I mean, those are harder to document, but in general, if you can try to get all that figured out and get it into your accounts ahead of time, that's usually works a little better. So myth number 4, and our final myth, is having debt or student loans is a deal breaker, for getting a loan. And again, that's not the case. Mortgages, all these mortgage programs that I mentioned before allow for you to have debt above and beyond what your housing payment would be. So you're good with that. You can have, the way it usually works out for most of these programs is they look at a ratio based on your income. So whatever your gross income is, you can spend a percentage of it, usually around 30% for your housing payment. And you can spend about, depends, 40 to 45% in total for housing plus any other debts that you have. So there's obviously room there to have debt. And when I mention housing payment, just keep in mind, that's not just the payment on the mortgage. You have to include your real estate taxes, your, if you have mortgage insurance, if you don't have 20% down, that has to be included. And then some properties have homeowners associations. So you have to include all that in your qualifying ratio for your housing. But the debt side, quite often I'll talk to people that think there's no way they're going to get approved, and they're fine. I mean, they don't realize they can have more debt than they thought they could and still qualify for a house. But the student loan part has become more problematic, and each of those conventional FHA and VA have different ways of looking at student debt. Conventional, you can get away with, if there's no payment yet on it and there's just balances showing up, you can get away with 0.5% of that total amount as a monthly payment, and that's what we would count. So a lot of times that is a pretty low number or manageable number to get qualified. Actually, FHA is the worst. I think they're about 1% right now. So they take a full, even if your payment is lower than that, they make us take 1%, and that's what we have to count as your debt on that. And then VA, I think, is about, they take 5% of the total balance and divide that by 12, and they use that. So again, all this, there's a lot of complexity in all this, and that's another reason why somebody, after talking to somebody, I can determine if we're looking FHA, conventional, or what would work best. But it's that's kind of the way we look at it. But just know that you can use, you can have debt. And on an aside on this too, as far as your income, Some folks think they have more income than, only certain types of income are usable. And some folks thinks they have income that they can use, which a lender will not allow. So bottom line, if you're W-2'd or hourly, you're great. If you've been on your job, or have job history for 2 years, great. Yeah, it's pretty much needed. And we count college in that too. So if you just graduated and have a job for 3 months, you're fine. They count college as that 2-year history, so that wouldn't be a problem. But some things that we do run into that are a problem are, if you were a W-2 and then switch to a commission job, or some of your income turned to commission, we need a 2-year history on that to use the commission. So even though you might be doing great with it, for the first 6 months, it's not going to be usable. So that's a problem. Somebody that becomes self-employed recently, again, you need a 2-year history on that. So anybody that just switched, that's problematic. So those are some of the things to watch for as far as your income is concerned. So bottom line, in conclusion, just to kind of wrap things up, again, we don't have a lot of time here, but just to go over a couple things that what you should do to kind of get ready. Probably one of the biggest things is to kind of come up with a budget for yourself and kind of figure out what you want to spend for a housing payment. What you figure out might not, after you start looking around, it might not be doable, or you might have to make some adjustments to that, but at least you'll have some guide. You'll know what your fixed expenses are and what you have left to pay for housing. And then as we go through a pre-approval process, we can tell you if that budget, fits with what's doable as far as an approval. So that would be good. One other thing you want to do is try to clean up any credit issues you may think you have, small collections. If you have the ability to pay any revolving debt you have, that you have over 50%, have balances that are over 50% of the high credit limit on those accounts, you'll want to try to get those at or below the 50% level. That'll help your credit scores a lot. In small collections, if you can pay off any small collections that may be outstanding, you'll want to do that. Of course, save as much money as you can in advance, and or try to work out a gift or some other method if you're a little short on down payment money. You can, also educate yourself. Online, there's all kinds of information about mortgages and what you should be doing. And but again, I would probably stress, a lot of folks like to use online mortgage companies these days, which can work out, but it's just a little trickier. So if you have a good referral source to somebody, that always is probably best, especially somebody local, if you're buying local. And finally, paperwork, you want to get your paperwork in order. So in general, you're going to need 30 days of pay stubs, 2 months worth of bank statements, 2 years of W-2s and or tax returns in some cases, a picture ID, maybe divorce decrees, bankruptcies, or foreclosures, docs if you have any of that going on, and additional items after you give all your information to a lender, that might bring up other issues or topics or other items that may be needed from you, but you kind of work through that as you go through the process. So hopefully you found this info a little informative and helpful. And Barb, I think I'll send it back to you. I think that's about all I've got right now tonight.
All right. A few questions did come in.
Okay.
So I'll just start at the top. If there are two people signing the loan, are their credit scores averaged, or is the better, worse score taken?
Yeah, the lower score of a whether they're married or just unmarried or whatever, of anybody on the loan, which usually 4 is about maximum. Any lender is going to go off the lower mid score of the 2 or 3 or 4 or whoever's on it. So unfortunately, that's where it's going to go. And again, the lower a score gets, the higher the interest rate, and maybe more if you have mortgage insurance, those mortgage insurance rates are going to go up as well. So yeah, the credit score is a big component of all that.
All right, great. Another question is, how long is a pre-approval letter good for? 60 days, 90 days?
Yeah, a pre-approval is usually good for between 90 and 120 days in general, depending on what documents you've given. The documents expire. As they expire, some are older or newer, whatever you're giving, whatever month's bank statements you have or pay stubs. So figure 90 to 120 is a safe amount. And it's, if nothing has really changed in your financial picture, it's not that hard to update it. So not that big of a deal. You obviously might have to pull a new credit, get some new info over, but it shouldn't be, too big of a deal.
All right. And then do we need a pre-approval for each offer put on different homes? So maybe how does that whole process work?
Not in general, and Sue can speak to this as far as what she likes to see on a pre-approval. I've worked with some agents that want like the max amount somebody can get pre-approved for on it, and some want something very similar to whatever property you're making an offer on because they don't want to show that you're well qualified or overqualified for the property, maybe thinking that would change how they negotiate with you. But in general, no. The pre-approval letter is just kind of a blanket letter saying you've applied, you've had your credit looked at, so on and so forth, and you're good up to X amount. Now, of course, things can change as you look at different properties. Your taxes might be different. You might have one property that has an association fee and one that doesn't. So no, those are big factors, in how you could it would change what you qualify for. I was just working on a deal for somebody that was trying to buy a single family house, and all of a sudden they switched to a fairly, slightly less but similar priced townhome, condo that had like a $600 association fee in that complex. So that would change the numbers quite a bit. So you'll just need to keep that in mind.
All right, thanks. And then last question that I see is, please repeat the paper we should get in order. So
sure. Yeah. And again, you can find this on any website or internet, but bottom line, in any lender that you work with, as you go through the pre-approval, they're going to send you an email list of this and be pretty specific, but you'll need 30 days of pay stubs in general. So last 2 or 3 pay stubs, depending on how often you get paid, 60 days of bank statements, and you'll want to make sure you get all the pages. Even if the last page is blank, if we see on the first page it says 1 of 4, and you only send us the first 3, we're going to ask you for the 4th one. So a lot of folks, for some reason, throw away the 3rd page. They keep the statements, but they throw away the 3rd page or the 4th page because there's nothing on it. You'll want to start keeping all your pages. 2 years of W-2 forms, or 2 years of tax returns if you're self-employed. 2 years of business returns, and you'll want your K-1s. There's other, not to get too detailed, but there's other forms for self-employed folks. But basically, bottom line, 2 years of all that kind of information is what you'd want. Picture ID. Again, if you went through a divorce and somebody's paying child support or something along those lines, you'll definitely need a divorce decree. And if you've had a bankruptcy or foreclosure in the past 7 years, you'll probably need to have that kind of paperwork handy as well.
All right, thank you. A couple more came in.
Sure.
Can you please add, if you put more than 20% down, does that help you in any way?
There is on mortgage, on conventional loans, and you probably would be going conventional if you're doing 20%, because once you've done that, you're not going to have mortgage insurance any longer. FHA and VA have a mortgage insurance component regardless of how much you put down. So there's really no reason to go with that unless you just have a credit score issue that's causing a problem. But so once you put 20% down, obviously you get rid of the mortgage insurance component, so that saves you there. But once you can hit the next figure you want to hit is 25% down, because once you've hit at 25%, the conventional conforming rates get better. That's but beyond that, they really don't change as much. So that would be where you really want to strive to be at if you had the money to do it. 20 obviously is good, but if you had the extra and you wanted to put 25, that will usually get you an eighth or so better on the rate.
Great. And then could you talk a little bit about credit scores. Someone asked about if a credit score of 715, is that a good score?
Sure.
And
Yeah, I would say, I mean, like I mentioned, 740 is going to get you into the best rate category. I would say anything over 7 is still going to be pretty good. Each 20-point drop or tranche, between 740 and 720, is almost, you won't see much. It might not even be a rate differential. It might just be, instead of a lender credit I could give somebody for $500, now I can't give them a lender credit, but they still get the same rate. Once you get from 720 to 700, then maybe the rate gets an eighth worse. It kind of accentuates the lower you get. So but 715 score, I mean, you'll on any of this, down to, on a conventional loan, 620 is about the minimum you're going to be looking at. FHA and VA around 600. But any of it is still approvable. I mean, I wouldn't let that stop you. I mean, obviously rates are going to be higher, but I wouldn't let it shy you away from trying. At least, at that point, you're going to still get approved. More than likely, you're going to pay a little more.
okay. We do have a couple more questions, but I'm thinking we should move on, and then I'll come back to these questions if
Sure.
we have time at the end. Okay.
Great.
So thank you very, very much, Russ.
Thank you. Yep.
And now I'm going to turn it over to Sue and Megan from Picket Fence.
Hi, everybody. I'm Sue Duchek, with managing broker and owner of Picket Fence Realty. And this is Megan Speck. She is a buyer's agent specifically. So we wanted to kind of share each of our perspectives for you. This is exciting time. Obviously, first time home buyer is a, exciting, stressful, but that's where I like to say you need to build your team. Russ was absolutely correct in terms of that first stop being prepared and really getting your lending available, documented, so that when you do find that property. We're going to talk a lot about what you can do to get to be the strongest buyer you can be, because you're unfortunately or fortunately in a market where it is crazy. I've been doing this. I mean, Picket Fence is 24 years this year. I've been licensed for over 40 years. And it's historic in terms of what you're going to be encountering. So the stronger you can make yourself and really build your team. So in terms of building that team, yes, it starts with a lender. And then it really does move into looking at, to Russ's point, they're going to give you what you can afford, but what do you want to spend? Two different things sometimes. So really looking at the numbers, what makes sense for you, and making sure you're being realistic in your expectations. The next thing is finding that broker that's really going to listen to you. You need to have an advocate for you to make sure that they are looking for every opportunity. There's so many search engines out there where you can do your own cursory search, but having somebody who is, I think it's very important to be really specific to the area you're looking for. There are so many more tools than just what you see online. There is a new product out there right now called the Private Listing Network, which is a broker-to-broker conversation. You may see coming soon signs. Those are things you as consumers are not going to be able to research specifically. And then there's just making sure you've got somebody who knows your market, so that the conversations they're having, you kind of get that first look, that first bit of information. It is exciting, it is stressful, but it can also be a really very satisfying end game when you build your right team. So I'm going to let Megan talk a little bit. She works with a lot of buyers, and it is a different process than what you might anticipate.
So I have been doing this for a really long time, and I have worked with a lot of buyers. And I always tell people when they start this process that get an idea of what you're looking for, but absolutely have a very general search that you want to set up. Areas, types of houses, number of bedrooms, bathrooms, that kind of thing. Don't get too caught up in the minutia of where you think that you want a fireplace to be, or if you want hard floors here or there, or if you want white cabinets or whatever. the vaguer that you can keep that search to begin with, it's going to make a house be your home. And we have the tools to help you find that house when you're ready to get it. It's not just looking for a split level or a ranch or a townhouse or a whatever it is you're looking for. It's really like this is your biggest investment that you're going to make. So what's important to you? Do you need to have absolutes? There are things that are nice to have as a search, but what are your absolutes? Do you have to have a garage? Do you have to have in-unit laundry in a condominium? Do you have to have access to the train? Do you have to have this, that, or the other thing? So that's where we build our search from. And then we kind of dial it down from there. The other thing is listen to your realtor. If your realtor goes out with you a couple of times and knows you as a person, they're going to find the house that's perfect for you. They're going to really trust them when they say, there's a house that's a little bit outside of what you were talking about, but I still think you should go take a look at it because I know you, I've met you, I've gotten to know you. This might be a good fit for you, even though it wasn't on paper what you were looking for.
We call it the realtor's choice.
Yeah, realtor's choice. Realtor's choice.
Get in the car, we're going to go look at
yeah.
this.
So, and we're in a marketplace right now where I'm the person looking at all this stuff 3, 4, 5, 7 times a day. And if I see something that comes up, you probably should go take a look at it right away because we're not in a marketplace where you can just hang out till the weekend and see what happens. It's honestly something you should like build a timeline in. And that's what Sue was saying before is like, if you are in a rental situation, a certain living situation, figure out what your timeline is, because right now you don't have 3 or 4 months to put a contract in and wait till closing. We're looking at most sellers that are looking for a 30-day to 45-day closing time. So you need to have all your ducks in a row before you go out and take a look at property. And we're happy to set, like as a realtor, we're happy to set that search up for you and take a look at property with you. But when you're ready to go, you have to be ready to go. Right. And that's where someone like Russ comes in place, that he can get you pre-qualified. You have to have that information together before you even make an offer on something.
Because the fact of the matter is right now with the environment because of the year we've just had, there's a huge movement from urban to suburban, and first-time home buyers, certain price pockets are really, really competitive. So the more homework you can do before you're really ready, again, back to Russ, but also really to your wish list. We talk about the wish list and then the must-haves. Know if schools are important, do your homework on the schools before you start looking, because why waste your time or anyone else's time looking outside of where you're going to need to be? So really looking at what you want, but then it is also really understanding the process of when you do find that house, and because you're not afforded the luxury of time right now, have someone who is going to be able to really navigate that with you. It is someone who's going to know your marketplace. Is it priced properly? Is it priced, we used to say 97% list to sales price ratio, meaning if it's listed at 400, you might be able to get it, maybe 392, something like that. We're finding we're getting multiple offers. We're getting full asking prices. There are some tools to help you possibly secure it with how to negotiate. Having designation in negotiation in real estate is something that is important. You need to understand the dynamics of it. It's not always price. Is it as is? And as is can be kind of scary sounding, but as Lucas will talk through, it doesn't mean you waive your right to do your due diligence and have that home inspection done. It just means you're going in with eyes open and potentially might be willing to make an offer that is as is and not ask for anything on a home inspection. Still gives you the right to withdraw if something insurmountable comes up, but there's just understanding all the dynamics of it and really having somebody who is going to have your best interest and be able to, kind of hit the ground running with you. It is a time where the more prepared you are, and congratulations for taking time out on your Wednesday night to sit through a program like this, because these are the tools that you're going to need to really be ready to be your best buyer. So in general, yes, it's very exciting, but it's also a huge decision. And we want to always make sure that we are able to get you in the position to be competitive. So it looks like we have a question here. As a buyer, what is the typical fee of the contract signed for using a realtor? Good question. It is the way that in our area and all over the country, it varies, but the fees for working with a buyer's agent are covered by the seller. It's part of the commission. It's called a cooperative commission. If you, depending on what agreement you come with your buyer's agent, those fees do not come through to you in another form. Yes, it forms into the purchase price potentially, but there's going to be no additional out of pocket for you to then be using a realtor. Another question here is the benefit of buying first home in the current market, especially anticipating larger homes. So we're getting questions about, are we expecting prices to settle down? I think there's such a pent up inventory that it's going to be a while before we see that leveling out. It just comes down to what is your motivation to become a buyer? You know, there's all kinds of reasons people make those decisions. So there's not one just answer for that question.
Currently, homes are going for more than market price. The market is what the market bears. So I think that to say that homes are going higher than market price is a misnomer, only in that we deal with this every day and we're seeing these homes appraise out at their purchase price or above. So I don't think that that's true. I think we'd all love to think that like that's always the case, but right now it's not necessarily the case. It's supply and demand.
Yeah.
And
we do have this pent up, we have this
pent up demand and not enough supply.
Right. So it is what the market's going to bear, but then back to the lending, there is still going to be that threshold. It still has to appraise out.
Yeah.
So again, that's where you have to rely on your broker to say, we're not going to get this thing to appraise out, because the last thing you want to do is get under contract, get your home inspection, get very excited, and then have the appraiser come through and say, yeah, no. So having, again, that broker to be your advocate to make sure you're making good decisions as best as you can.
Okay, so I see two. Should we wait until the market comes down?
We don't know when that is.
Yeah,
you know,
if I had a crystal ball, I'd be a millionaire by now. And then you've given 4 offers on homes, but all went more than market price. I'm guessing that they all went more than the asking price. And if I'm incorrect on that, please correct me, but I'm guessing that they went over what the asking price was. And we're seeing that a lot in homes right now. And there are a couple of tools that you can use to make sure that while you're not overpaying, you're still putting yourself, you're situating yourself in a place of being in front of the rest of the buyers that are offering the home.
And it could be kind of a long conversation. Always happy to discuss it later, but you know, again, it's a tool. It's an escalation clause. It's saying, I'm willing to pay this, but I'm willing to go up to a certain amount. And that's where you have to look inside yourself and say, what am I willing to pay?
Right.
And then if you don't get it, you say,
then I walk away.
Off you go, and you feel good about your decisions.
And that's what I say to clients. What is the price that you're willing to walk away from this house on?
Yeah. So it's an escalation clause. It's going in as is potentially. Again, you can do your due diligence, but at least the cleaner your offer is, the stronger buyer you're going to be. I don't see any other, how much time is given to sell your client's home when you put an offer on another home.
So home sale contingency. There are a lot of contingencies that are attached to a contract. Typically, the major ones are a mortgage, inspection, attorney approval, and then there comes a point where you're like a home sale contingency. So you have to sell your house in order to buy a new house, or you've sold your house, but you have to wait for that house to close in order to buy a new house. That's a separate contingency to the contract. It adds another layer of liability, not liability, risk for the seller. And so most sellers require, they'll typically what we see is like a 30-day time for you to market and sell your house, and then another 30 days for it to close before the closing of the house you want to purchase. So say 60 days total. I think that's probably a pretty average time.
I work with a lot of listings, and so if I have an offer coming in and it's a home sale contingency, I'm looking at what do they have to sell, how long do they want. But the reality of it right now in this marketplace is that sellers are not looking at them. It's very difficult. And I know it's a catch-22 because you need your equity from A to get B. So that's again where you need to have an advocate, a broker who's going to be able to explain all your options and give you a good game plan.
And like Nancy says, yes, it's better to sell it is better to sell your house first if you can. It's not ideal. No one wants to be homeless. We try to make sure that doesn't happen.
It's a leap of faith.
Yeah, it's a leap of faith. It's a leap of faith. I also see that Sagar wrote, what's the tool name to verify your house? I'm guessing you're asking about
the appraisal,
verifying the market value of your house, the appraisal value of your house. Okay, so typically you have an appraisal done once you purchase the house. Like Russ said, the mortgage company would then order an appraisal once you've gone under contract, you've gone through attorney approval time. The mortgage company will order an appraisal. An appraisal will come through the house, take information from historical information from other homes that have sold in the area in the last, hopefully 3 to 6 months, and put together a report based on the differences in pertinent features of your house compared to these other homes. But if you're looking for a value to purchase a house, I, as a realtor, would always give you comparable sales to kind of have an idea of where the market price is for this house compared to where it should be or not be, or if it's underpriced or overpriced. It kind of depends on what you're asking for.
Right. So the next question is, can you legally walk away from it in the home buying process? So there's once you have a meeting of the minds with buyer and seller, there's a 5-day attorney review period, and the attorney is another component of your team that you're going to want to build. So Lucas is the one, or the inspector is the one who does the inspection for you to do your due diligence. The attorneys then review the context of the contract. At that point, you're out of attorney review. Now, if you have a lending contingency, that's still out there. But it's not that you should just go into it with the idea that you can legally walk away. If for some reason you don't qualify for your loan, or your employment changes, so now you can't qualify for a loan, that is something that will nullivate, have to step away from a contract, and your earnest money is protected. But again, that's a legal question. You'd want to really drill that in with your attorney for your team. So I don't see any other questions. Certainly, if any others pop up, we'll answer at the end. But again, big partner in this whole process is your home inspector, and we will turn it over to Lucas.
Thanks, guys. Thanks. My name's Lucas. I own True Home Inspections here in Arlington Heights. I'm going to be going over the home inspection process and hopefully answer any questions that you guys may have. The home inspection process typically starts with your attorney review period. Once you've put an offer on a house, you have 5 days to do that home inspection, or any inspections in that matter. The home inspection is going to be a visual inspection. It's non-invasive. We don't open up a lot of equipment. Obviously, we can't see through walls, finished basements, things like that. So a visual inspection, meaning things that are accessible during the inspection process. It will go over everything from the roof, the exterior, the structure, electrical system, heating, air conditioning, plumbing, insulation, ventilation, and the interior components of the property. In the state of Illinois, you do need to be a licensed home inspector. In the state of Illinois, you do not have to be insured as a home inspector, which is unusual. So that definitely be a question that you want to make sure that your home inspector is insured, because a lot of inspectors that may have lower fees, that's an easy one to not pay as a business owner. Myself, I am an ASHI home inspector. I'm an ASHI certified inspector. There are organizations among the home inspection industry that typically the inspectors will inspect beyond the state minimum requirements. So I would recommend that if you're hiring a home inspector, you're looking for an inspector that has a number of years of experience, preferably some type of contracting background, and that they're affiliated with some organization. ASHI and NACHI are the two bigger in the country. A lot of home inspectors will offer other services, radon testing, mold, asbestos. Some are getting into sewer scoping as well. During your inspection process, it's really the objective of the home inspector to give you as much information about the property as possible. Obviously, we're focusing more so on the big concerns, health, safety, expenses. Those are the things that you're really focusing in on and not so much the cosmetic defects. Every inspector runs their businesses differently. Myself and our company, we do try to comment on the full spectrum. Obviously, we are focused on the major defects, but we also will comment on a lot of the minor defects in the property, more or less to give a full scope of the property. I've personally obviously been through inspections myself, and I really like the fact that I know if a light switch isn't working or an outlet or some of these little nuances with hardware and doors and things like that. Even though it's not a big issue, sometimes a lot of those little things can add up. So it's really the inspector's main objective is to give you as much information as possible about the property. I think another good piece of advice would be most buyers have never really been through an inspection process, or if they have, it's once or twice before. So it's really difficult to compare one inspector to another. So I think, and I usually advise people that are asking about my company, I think one of the best ways to compare home inspectors is to compare sample reports. Ultimately, it's how the inspector is communicating the deficiencies to the buyer, you, and seeing that finished report and how that information is given to you is really important, that you're digesting the information and taking it and you understand it. So it's really important. And one of the best tools is to compare inspector company versus another inspector company is those sample reports. In the area, I kind of touched on it a little bit, some of the services that other inspectors are offering. Radon testing is becoming pretty popular. I would say half of my clients are doing radon testing, and it somewhat does determine the area that you're purchasing a property. For instance, the city of Chicago, like the 606 zip code, it is very low radon levels. As you move away from the city of Chicago, those levels do increase. So that'd be a good question to talk to your agent. They usually have a pretty good idea of the radon and whether they recommend it for particular areas. And it's something that you could look up online as well, as far as like radon levels per the zip code that you're purchasing in. So you can kind of get an idea if you are going to add those tests to the home inspection. There are definitely limitations when you are inspecting the property as far as accessibility. With the weather we've had for the past 3 weeks, there's been very little roofs that I can inspect. I personally try to walk on all roofs if weather permitting. So there are limitations seasonally to purchasing a property. And your home inspector will document these things in the inspection report so that you can request more further information, attorney to attorney. But that's one limitation seasonally that we've just kind of been dealing with for the past, obviously, couple months. And there are pros and cons to it. As far as inspecting seasonally with the snow, you can really see how houses are reacting to the weather when it's this extreme. So there are pros and cons. Another limitation that we deal with right now, which is a common issue is that we really can't run air conditioners unless it's above 65 degrees. So it's going to be based more so on the age of the equipment, as well as a visual inspection of the equipment, but that equipment will not be able to be operated unless it's above 65 degrees. Finished basements. A lot of people have concerns when they're purchasing properties with finished basements. And the biggest question is if it has flooded or seen water. There are a lot of limitations to not seeing that foundation and how it's reacting to obviously the weather and water intrusion. As inspectors, we know other signs to kind of look for to see if there's been a history of that. But with finished basements, it is a difficult thing to give someone 100%, and nothing's 100%, but to give someone a really good idea as far as how that basement is, kind of the history of that basement. You should typically, I'm kind of jumping around, you should typically call a home inspector as soon as your offer is accepted. As Picket Fence talked about, it is a very, very busy season right now for purchasing homes. And with a 5-day attorney review period, when you would typically book your home inspection, your inspectors and everyone is just so busy, the schedule is really filling up pretty quickly. So you really want to call your inspector as soon as possible. You could even call before your offer is accepted. I've been having a lot of people call before their offer is accepted in anticipation to kind of see what that schedule is looking like. And that's definitely a good idea to kind of ask those questions of your inspection company to make sure that they're going to be able to facilitate the services that you need in the time that you need as well. Another thing is a lot of clients are not concerned, but question. A lot of my business is realtor referrals. And this is about that team that you're building. If you're working with agents that you trust and are obviously looking out for your best interest, they typically have their team in place with home inspectors that they've worked with and know their products and services provided. And I would say 90% of my business is agent referrals. And that's very, very common in this area. And I always reassure clients that may be weary of that. There's nothing that would bend my ethics as a home inspector for any relationship that I may have with a realtor's office. I really like the fact that as a home inspector, it is what it is. I take photos, I document these things, I support the evidence that's found. And it is what it is. You know, I truly don't like finding sometimes some of the concerning things, mold, asbestos, structural issues. Those tend to be some of the bigger ones. I want people to find a house that's great and it's like a slam dunk. And it makes my job easier when I look for these things and don't find them. So I definitely want to like reassure people about the realtor home inspection relationship that agents do typically refer a number of inspectors to kind of keep it unbiased, but sometimes we'll say we focus or we really like this company a little bit more. But you can navigate that as you feel comfortable. The inspection process typically will take about 2 hours, 2.5 hours on site. The inspection reports typically are going to be emailed through a PDF. And legally, a home inspection company has 48 hours to get you that document. So business hours to get that report to you. Our company, we get them out typically same day. I try to tell clients within 24 hours. With home inspection companies, they're trying to get the information out of their software as quick as possible in a timely manner because you're dealing with attorneys, realtors. You need to digest the information and draft letters if necessary. So most home inspection companies are within 24 hours, but legally have 2 business days. But I don't know too many that are taking 2 full days to get you those finished reports. Home inspections do not pass fail. It's not a pass fail situation. It's not a 1 out of 10 situation. Those are pretty common questions at the end of my inspections. It's really the objective of the home inspector to just give you as much information about the property, the age of your equipment, furnace, roof, AC, water heater, and point out any major defects. No house is perfect. I've yet to meet a one, new construction or not. There's always small little nuances of things that can be improved upon. And with older homes, sometimes that laundry list can be a little bit longer. So there is no perfect home. It's just having a home that you can anticipate those repairs and replacements of equipment when needed. And that's really the home inspection document should outline at least a general life expectancy that's left in that equipment. That's pretty much the basic as far as like what's covered through the inspection. I kind of want to leave it open for some questions in case there are some, so I can kind of dive into a more detailed questions that you may have if you have them.
Yes, there are questions.
Perfect.
Okay, I'm going to start with who pays for the home inspection and how much does it generally cost?
Good question. In Illinois, the home inspection is paid by the buyers, separate from everything else. So typically payment is due the day of the inspection. That's when I take payment. Most home inspection companies take credit cards. Personal checks is pretty common, which is somewhat unusual, I think. And then as far as our company, we try to use cutting edge technology as well. So we're Venmo, Chase Quick Pay, PayPal, Apple Pay. Like we make it easy for you to make payment. And then as far as the amount, that ranges really company to company. But generally for a single family home, I don't know anybody that's, so you're looking at like 400 to 600 for like an average home inspection, I would say. I'm sure I hear of people that are sometimes cheaper, like $250 for a flat rate home inspection. Typically out in like DeKalb or further away from the city. But I truly believe you get what you pay for a lot of times. And that's where you can justify fees with the experience of the home inspector, how long they've been in business, the software that they use, the insurances, and things like that. But I would say for the average single family home, you're probably finding inspectors from $400 to $600. Radon testing is going to be a range from, I've seen like 190 to 145. Those are the two common inspections that are performed during your attorney review period.
All right, great. What is the life of a roof? Well, when you buy a house, is that something that you should check out?
Yeah, usually when you have a good team of realtors, they're looking for these things because roofs are so expensive. They're gonna know if that roof is toasty. They will obviously, when you buy houses too, they're listing houses with newer roof and they're telling you the years that roofs have been installed because they're so expensive. Depending on the material, the typical roof on a house is typically an asphalt shingle. They're generally a 18 to 20 year for a 3-tab and a 25 to 30 year on an architectural shingle, which is becoming more of an industry standard.
Thank you. Someone asked, would it be a good idea to get a plumber, electrician, HVAC company to do an inspection along with a basic home inspection?
Yes and no. It depends. So plumber, yes. To camera a sewer line is money well spent because sewer lines can be so expensive if there's a failure there, blockage or cracked tiles or anything like that. This is also nice where you deal with a home inspector who's from the area that you're purchasing or is familiar enough with it. I live in Arlington Heights, so I know a lot of Arlington Heights streets that are dealing with offset mains from sewers. Typically on older homes too. when you're 70s and earlier, you're going to be dealing with some materials that are more prone to failure, or just older systems. So a plumber is money well spent, regardless. HVAC, I've only recommended that if there's like specialty equipment. I inspect boilers and central forced air systems like all the time. But sometimes you'll get into like, radiant heat and concrete walls and things like that. If you have specialty equipment there, sometimes it's a good decision to bring an outside specialist, but it's rare. The home inspector can handle the basic operation and inspection of your typical HVAC system, boiler included.
All right, thank you.
Electric, yeah. And then with electrical, you don't necessarily, electrical's well within a home inspection's standards of practice. They'll remove the panel too to look at the wiring. That is one piece of equipment that most inspectors will exceed the state standards of practice. It's not required for home inspectors to open up electrical panels, but they all do. So electrical is well within the wheelhouse of a home inspection company.
Okay. Is a foundation inspection included in a basic home inspection?
It is. It is, as long as it's visible. That's the difficult thing with inspecting basements that are fully finished. Sometimes you can see very, very small amount, 1% of it. You're inspecting from the exterior of the house. There should be exposed foundation. So you're trying to cue in any signs of cracks or deficiencies there, especially when a basement's finished. And then any nooks and crannies you can kind of get to see an exposed foundation, typically like sump pumps are in unfinished corners. So you're trying to get glimpses of that foundation. When you can't see a exposed foundation, that's where you have to start as an inspector looking at secondary things. You're looking for moisture intrusion and water staining and things that make clue you into other issues going on behind the wall. There are thermal cameras. Not every inspector carries them. We do carry them, but we use them just like any other tool. They're not, they're not coming out on every single inspection, just if we see a reason to.
All right. And for when, how do I word this? They're asking about asbestos inspection.
Yep.
And what years
Yep.
is that a prevalent issue?
Yep, I got it. It's a really good question, especially because if you're purchasing a house that was built prior to the 80s is really the cutoff, but it's somewhat rarer from 70, 80. But the 80s is really when asbestos has stopped being used. If you're purchasing a house that was built prior to the 80s, familiarize yourself with asbestos and whether that is a big concern with you. There are some areas as an inspector where I see asbestos, and your agents, because they're in so many houses, they could usually call out a lot of the asbestos materials, like the vinyl floor tiles that are 9 inches by 9 inches. So it's something to look out for when you're purchasing a house. It's not as much of a concern as long as it's not breaking up and becoming airborne. So that is a very common asbestos material that we find in houses, that it kind of is what it is, unless it's brittle and needs to be removed. We're just notifying clients to be aware that product is there. There is asbestos in other areas where it's more concerning because of the likelihood of it becoming airborne. And those are the things that your inspector should document in their reports as findings of asbestos in any material. If you're buying like old Chicago bungalows, Victorians, we could pretty much assume that the product is there because they used it everywhere. They used it in caulking, they used it in vinyl flooring, they used it in insulation, plaster. It was used pretty frequently. So trying to figure out where you fall on the spectrum of the A word, asbestos, and whether or not you're willing to live with it or willing to pay to have it removed.
All right. Someone asks if you see bait stations for mice, would that be any concern?
No, but I've seen a lot of well, it's tricky. It's all personal. Really the home inspection is to give you the information every single buyer is different. So I'm never there to determine like where you fall on the spectrum of throwing in the towel. I'm just there to give you the information so that you're comfortable making the purchase or you need to reassess. Bait station, I mean, a lot of houses have pest intrusion. Um, it's really common. So yeah, it'd be almost something you almost have to be willing to find or discover during a home inspection. I would for sure comment in it in my reports that there's pests, but I'd be more so concerned with other pests over mice, termites, post beetles, things, carpenter ants, things that are going to start degrading the property and the structure. Those are the freak out pests. Bats, honeybees, raccoons, squirrels, all of that stuff is a little bit more detrimental to house. With that being said, I've been in some attics that have been infested with mice. That's no good, but a couple bait traps and some droppings is somewhat normal.
Okay, and then our last question for you, I think, is someone asked which year house is the best to buy?
I was looking at that. That's really a personal preference, but I would say new construction is typically my easier inspections. Because they've gone through like a village inspection as well. Usually if someone hires me for brand new construction, I tell them, you're just doing your due diligence. Don't expect me to find a huge laundry list. This property has been inspected by the village, plumbing inspector, electrical inspector, insulation. Villages will do their inspections as well. But that's really a personal thing. I personally live in an old 1926 Chicago bungalow, and I was looking at Victorians and really old properties because that's just what I think is good to buy.
All right, well, thank you, Lucas.
Yeah, of course. Thank you.
There are a couple of questions that came in that I'll just read out and let you guys decide which one will answer it, if that's okay with you.
Mhm.
One, by law, does the seller have to disclose a flood? So I wasn't sure who.
So this is probably a Lucas and a broker question. So sellers have to complete 3 disclosures. It's a lead-based paint, radon, and then a seller's disclosure. And one of the questions, there's specific questions about, I'm aware of reoccurring flooding or leakage. So yes, they do have to answer that correctly. That doesn't mean you take it for a fact. That's when you call Lucas and, or whomever, and then you do your due diligence. And as far as flooding basements, there's so many tell signs that your broker probably already picked up on. And yes, you can't see behind the paneling to see what's happening with that foundation. But if you've got an active leak or a flood, you're going to know about it. That's my
Yeah.
tip.
And as a home inspector, we look for those signs of previous repairs. Usually if a basement floods, they're going to be cutting up like the 1 foot off of the drywall. So we'll see a seam there, and we're shining flashlights and we're looking for patched drywall throughout the property, but in basements specifically, that shows sign of obviously a flood. That's typically how they'll repair that. Kind of little tricky things. You can actually find drywall stamp dates on them too sometimes from the manufacturer. So when I see those 1 foot splices of drywall, I'm really looking for a date on it. So I can be like, this was repaired in 2018. Like, it gives you a little bit more information to be like, what happened in 2018. So yeah, you're definitely looking for that. The other thing I tell clients, because we're in Chicagoland area, we have basements in most properties. And it's not to be smart, but it's a hole in the ground. It wants to fill up with water. It's below the water line with downspouts and things like that. So having sump pumps and things like that fail isn't totally uncommon. And that's where typically seasoned homeowners will spend the extra money once they purchase a property to do the battery backups, to do the secondary pumps, to get the early notification sensors and alarms and things like that. And those would be things that as an inspector, I talk to my clients about. But as far as like the inspection process, we're looking for bare minimums, and a single pump that's working in a sump pump is a working sump pump. But with finished basements, it's always wise to protect that investment with backup pumps, batteries, and things of that nature.
I think there's, for a first-time home buyer and much to do with the inspection, it's important to understand that in the context of the contract, it really says you're not looking for the day-to-day wear and tear. It's not the things that you saw when you purchased it and put that offer in. It's safety and things that are broken is really the spirit of what is reasonable to ask for in a home inspection, or not a home inspection, but during the in things that were a surprise to you. You know, we're not climbing up in the attic and get up in the attic and there's mold. That's environmental, that's a safety, and you didn't know about it. So that's going to be something that's going to be within that realm of reason. But so many times, particularly in a competitive market, if you're doing a home inspection, and to Lucas's point, there's always going to be a list of things, and you just have to make sure it really falls within the scope of what's reasonable to ask for, because otherwise you're setting yourself up for unrealistic expectations. And again, that's where your broker is going to be able to have you navigate. You know, when you came into a house and you saw that it had, you know, settling, you know, the driveway is like crazy. It's cracked. It needs resurfacing. That's maintenance. That's not something that's going to fall within a reasonable request in home inspection. But again, safety of mold, radon, those things do fall within reason to ask for. So again, just keeping expectations straight.
Great. All right, I have a question from earlier that I'm going to ask Russ, and then I'll go back to the ones that are fresh coming in. Russ, we had a question. If you were unemployed in the past 2 years, but are now employed, will that hurt your chance of getting pre-approved for a mortgage?
If you've been back at a new job for 6 months or longer, then you should be okay. Or if you didn't have a gap of more than 6 months in that 2 year, I'm not sure if you were 2 full years or had sporadic employment in there, but as long as you've been back for 6 months, you should be good. And if you've had employment that wasn't more than 6 months of a gap, then you should be good as well.
Great, thank you. All right, another question. How is property tax calculated? Anyone know that one? Nobody here is a.
Yeah, I would defer to you know, your assessor's office, but basically the taxes, it's a slippery slope. So it's square footage, it's how large is your lot. It is to some degree, what is the sales history? And then what taxing bodies are you in? You know, in Arlington Heights, we play into two different, we've got Wheeling Township and then we have Elk Grove Township. Those taxing bodies are calculated differently. So there's not a pat answer to it. So happy to answer that offline in terms of a little bit more detail, but it is a whole conversation in and of itself.
All right, and how do you negotiate the price down based on your findings? Does the lawyer help with this, or?
Mm-hmm. So
Yeah.
once it's under contract and you have a meeting of the minds and you've done your home inspection, that conversation is attorney to attorney, at least locally. And it's not so much you don't go into it with the idea that you're going to renegotiate. That's really not the spirit of it. But if there's something that is going to have you want to step away, typically a request will come through the attorney to attorney again, itemizing the items that were of an objection. And it'll say, you know, electrical panel was found to have a double tap. Please have it addressed with a licensed electrician. And then it'll go on to the next one. Sometimes it does become about the seller throwing a lump of money at it. You know, in lieu of repairs, we would like $2,500. We have to be a little bit careful with that. And I'll have Russ ring in on this. Lenders don't want to see these, you know, there's a limit to what you can ask for. There's a limit of what is considered reasonable, but that conversation is at the attorney level. Certainly as brokers, we ring in, but the final conversation is with your attorney.
Yeah, to speak to that from a lender standpoint, you'll any credit you get, you want to call it a seller closing cost credit, because yeah, it opens a bag of worms really if, if it's specific to repairs or things that need to be fixed. The lender could then want those things to be fixed prior to closing, which is the whole reason they're trying to give you this credit, to avoid that. So that would be one issue there. And as far as the amount you can get on something like that, usually that's maxed out at whatever your total closing cost on the deal would be, plus what they call the prepaid expenses, which basically are the setup of the escrow for taxes and insurance. So it can be a substantial amount. You probably can get, depending on the area and the tax bill on a specific property, you can probably get, to 8, 9, 10,000 even, in some cases. And there's also some limits, as far as your down payment, how much you can get as far as a seller credit, but it can be a decent amount of money, but you can't exceed whatever the closing cost and prepaid setup for your taxes and insurance for your escrow account. And, just to describe what the escrow account is real quick, because I don't think we've talked about that at all, but the escrow account is when you make a mortgage payment, there's a separate component to your mortgage payment. In a lot of cases, when you don't have 20% down, you are forced to have an escrow account where we set up a separate amount each month that goes for 1/12 of what your annual taxes are and 1/12 of your insurance. And like we talked about the mortgage insurance, that would go in there too. So you'll pay on the loan itself, you'll make one payment, but it'll be kind of split up between the more principal and interest for your loan. And the rest of it will go to that escrow, and that escrow will be set up so when your tax bill comes out, your insurance comes due, it all gets paid automatically out of that account. So you don't have to pay that bill separately.
Great. Well, that's all the questions that I have seen tonight. If anyone has any more, please ask them now. I know Jennifer has put your guys' contact information in our chat box a few times, so make a note of those things. Write those down if you need them. All right, we do have another question that came in. It says, can you use points?
You can, points are basically just a way to, if somebody's going to pay points, there's a way to get your interest rate lowered. So the more fees you pay up front in the form of points, and a point is just for an example, 1 point is 1% of whatever your loan amount is. So each point maybe drops your interest rate, 0.25%, maybe 0.3%. Then you get into the conversation, is it worth that? You can do a pretty quick analysis. If you had to pay 1 point, what does that save you per month? And how long does it take to break even, on the savings? So if you tell me you're going to live there, this is a first time home, I'm only going to be there 5 years. Usually it's not going to make sense to pay points to get a lower rate. If this is your forever house, or you think it is, and you're going to be there a long time, and with rates as low as they are now, the chances of them being lower in the future to refi might not exist. So maybe it's worth it to pay points, or even some portion of a point, maybe a 1/4 point, or just to get to that next lower 8% rate. So there's a lot of conversation around that you can have, and there's even a way to get money paid back to you if you actually. Some people take a slightly higher rate than the market, and can get a credit back if they have a bigger need for, some help with down payment, not down payment, but help with the cost involved in the loan. So that's kind of the way it works for the points, but it can go either way on that. You can certainly do it, but we don't see a lot of people paying points, to get a lower rate these days.
So I'll just hop in real quick. So you're kind of, Russ, you're kind of speaking of buyer's points. There's also, in negotiations in an offer, a buyer can request a seller to pay points. And again, that kind of is a big conversation to have with your broker that you align with. But bottom line, if you're asking for points, the seller, it's really all about the net. So if you're asking them, they're saying, here's your full asking price, but I'm looking for 3% in closing cost credit to help you with your closing costs so you can have a little bit more down payment. Know that the seller is not going to look at your 400 number, they're going to look at the, 12,000 under that is really your offer. So your broker can counsel you, but there are times, I haven't seen a whole lot of it in this competitive buyer's market right now, but that is a tool to explore should that make sense for you.
Yeah, rates are so low right now. People aren't spending the money to get even a lower rate because they're already pretty good. And like you said, yeah, you can get closing cost credits from the seller to use in multiple ways. And if we want to use some of it towards points to get a lower rate, you certainly can.
And what's an average closing cost?
On average, I mean, I like to talk about it being split between what the lender charges are and what the title charges are. The lender charges are going to obviously vary from lender to lender, but you can probably assume an appraisal fee of around $400 to $500. There's processing fee. Some lenders have 5 or 6 different fees that may add up to anywhere from, between the appraisal and the other fees they charge, anywhere between $1,500 to $2,000. Not to throw anybody under the bus, but the rocket type mortgage that you hear about, I mean, they're notorious for high fees. So it's all over the board. I mean, that's part of the shopping and looking around. You might get a great rate from somebody, but you really have to look at the fees because they more than likely are charging quite a bit more than somebody else that quoted you a slightly higher rate that doesn't have that many fees. And title, I mean, the buyer's portion of a title policy, again, it's all based on the loan size, but figure you're probably looking at another $2,000 to $2,500, depending on, again, the loan size. So, but there's also seller credits that you're going to receive, that we can't kind of count into these numbers. You're going to get credits for taxes and whatnot, more over and above what you really will need to set up that escrow account we talked about, for your taxes. So that actually helps lower the figure. So when I said before, figure you're going to need your down payment plus another $3,500 or so. By the time you get all the credits out of pocket to close your deal, figure whatever down payment option you pick, you'll need maybe another $3,500 on top of that, and that's what you'll need out of pocket.
And we see this all the time, and that's why really knowing your lender, to your point of not to pick on the rocket, but all these online options that are out there, it's so important to have a real face and a real voice to talk to and ask those questions when you all of a sudden it's getting closer. I know it's a frustration of mine is when I don't, who am I calling? Where are they at? But it's front end, make sure that you are asking about all their endorsement fees. I mean, get that truth in lending statement, which should give you a good idea of what their fees are. It's not just rate.
All right. Well, this has been a great program tonight. I want to thank all of our presenters, Sue and Megan and Russ and Lucas. And I'd like to thank everyone for coming tonight. I hope you all learned a lot. I did. And enjoy the rest of your evening.
All right. Thank you.
Thank you.
Thanks, guys.
Thanks all.